morning, folks, on tax day. Thanks for joining us on this Tuesday, April 18th at 11 a.m. Eastern time. I know some folks are in different parts of the country. Madeline is joining us from the central time zone where it's 2 hours behind, so I got her up and early this morning. We're happy to have you join us for the Q1 market review. We'll spend some time discussing the last 90 days and in turn, some insight as to what we see going on now, and then for the remainder of Q2. Before we kick off, we'll give a few minutes for folks to kind of trickle in, and then we'll spend about an hour or so together. In turn, we'll make the information available to you, probably send it out later this week. So again, hang with us for just a few, and then we'll dive right in. So we have a decent turnout. Now you can go ahead and kick us off. I'll let you let everyone kind of get ready for action-packed 45, 50 minutes with Mutt and Jeff, or Matt and Jeff, for anyone who gets that age-old reference. So
I hope everyone has their coffee. It's going to be a fun presentation here. So should I start sharing my screen?
Sounds good.
All right. So yep, Jeff, you want to?
Yeah, no. So
get us started here.
So folks, we're trying to make an effort to have timely insights to you. Obviously, the faster we can get stuff out to you, the more fresh the information is, the better. Again, we try to be ahead of some of the big wirehouses out there, but appreciate the fact that sometimes this information can be a little bit dated. But again, we'll try to be timely both with our quarterly reviews as well as content we're pushing out between now and our next meeting, which will be in July. So again, I'll let Maddie kind of take us into what's going on with Breakwater as well.
So we're really excited to be doing our second quarterly market update. We had one last quarter, so this is our second time doing this here. Really excited to be doing this. Our sources, not too dissimilar from the ones that you all saw last time, being, all the regulars here: Schwab, Morningstar, JP Morgan, and we'll send this deck out as well in an email after the presentation here. And just we'll get it kicked off here.
Yeah, so there are days when it seems like they're interminably long, and then there are days when you just look and say, oh my goodness, it's already 7 o'clock or whatever. And so I look at the last quarter as one, like, all that happened in just 90 days, right? You had obviously an interesting contested speaker appointment early on. Then you had us shooting down unidentified flying objects over parts of the US and Canada. Again, some of that stuff seemed kind of amusing, but obviously it's really in the face of heightened geopolitical tensions between the two superpowers of the world. And then by early March, our eyes shifted or focused to something that was eerily reminiscent of a period that goes back many years, where a idiosyncratic banking crisis really had put everyone kind of on watch. Just a quick statistic, which is interesting. So Silicon Valley Bank, which is obviously the one that everyone now knows about, who probably didn't know anything about on January 1st, they had 17 branches and $150,000 accounts, right? Basically with about $200 billion in assets. So, to me, when I think 17 branches, there are probably 17 branches of Bank of America in Bergen County or Paramus alone. So you can really speak to how unique the situation was there. Signature Bank and Silvergate, two others, is kind of the tough month for the letter S, were really more impacted by their exposure to crypto. The Fed gave us 2 rate hikes and start to talk about the end of their tightening cycle. We'll talk more about that obviously in the discussion. OPEC really kind of caught the market a bit off guard. technically this has actually really happened in the beginning of the second quarter, but I'll tie it into the first quarter because it does have some relevance, with a big hit to productions. It's really kind of coordinated across the entire OPEC members, which is very rare. The Sunnis and Shia, specifically Iran and Saudi Arabia, generally don't get along all that well. But that was an interesting development. Bitcoin, right? I know everyone's been talking about Bitcoin again after a bludgeoning that was 2022, and then fourth quarter earnings, soft by standards, but not as bad as they would have expected. And frankly, that's been the theme here in the first week. We really kicked off earnings last Thursday, Friday. We're going to a heck of a lot more in the next couple of weeks. We'll spend some time there. And then the last thing is Maddie and I weren't able to figure out how ChatGPT could do the seminar for us. We're working on that, but the rise of the machines is an important topic. There's an interesting piece from Howard Marks, someone I hold in high regard. He talks about the future of the factory, and you could say the future of financial services is basically a man and a dog, and the man's job is to go ahead and feed the dog, and the dog's job is to make sure the man doesn't touch the machine. So I don't think we're going to get there anytime soon, but again, nonetheless, worth probably spending some time on AI. So Maddie, thanks for letting me kind of summarize the big picture.
So first, we're going to start out with our economic update. Jeff, you want to give us a brief overview of what happened?
Yeah, so look, all the word cloud or attempt at there, everything we hear about is data dependency, right, from the Fed, and frankly, I think more people today tune into different days for the daily data point than I can remember in my career, right? So whether it's central banks, it's retail sales, it's consumer sentiment. You can understand why people get dizzy, and it's stuff we're monitoring closely. I think some of it is noise and some of it is signal, and it's just important to kind of filter that. So we're going to spend some time on a lot of these points as we kind of progress through the economic update, and then we'll get transition more to conversations about the different markets. We'll wrap up some comments on asset allocation, and then some things that kind of maybe keep us up at night, if I want to use the phrase. So, we're not quite to the final number. It's always fun, interesting. China reported their GDP last night, 4.5% for the first quarter. It's obviously a very large, dynamic economy, and the fact they can get a final GDP report out that quickly is miraculous. It speaks to the fact they kind of manufacture their numbers a little bit, but in the U.S., we're probably pretty close to putting a bow on the data. The estimates from the Atlanta Fed, which runs a real-time GDP forecast, have the first quarter GDP around 2.5%, which is above trend, which is impressive. If you look closer, and I apologize, some of these things are eye charts, it will be easier when you get this in front of you if you want to review it. But the range is from 2.5 to about flat for the economy in the first quarter. So the notion of a recession having started seems unlikely. What I call your attention to on the right-hand side is, generally speaking, economies go, right? Like they up and to the right is kind of the direction. We have very infrequent pockets of decline. That's what those gray bars are, recessions. But even recessions, other than the 2008, 2009, and the very, very sharp declines we saw in the midst of the pandemic, it really don't disrupt the upward trajectory of the economic output. And so again, thematically, if you're a long-term investor, that's something that basically you look at as an important investing concept. So if you want to look at manufacturing and service sector as two components of the U.S. economy, 70% of which is, again, service sector, and about 30% is manufacturing, it's a bit of a two stories, right? We have seen manufacturing contracting now in the U.S. for roughly about the last 4 or 5 months. But the positive sign is that we're seeing some strengthening manufacturing production in Asia. We're seeing a little bit of that improvement also in Europe. Again, Europe is still modestly contracting, but not nearly as much as it was. On the service side, the U.S., again, that's 70% of the economy, continues to show signs of expanding, although the rate of change is slow. We kind of put the rolling 12 months here, so you can see, at one point we're pretty consistently in the mid-50s. We had a small air pocket in December, only to have it reaccelerate in January, February, and decelerate again in March. Watching this closely, again, I think what you have to take into account, these are surveys, right? So you're just actually asking people, and we know that what people say and what people do aren't always the one and the same. So again, things worth monitoring from the ISM perspective.
And if we look at residential real estate here, residential construction makes up about 4% of the GDP, and obviously still how many Americans accumulate their wealth. So it's a really important piece of the economy to check in on here. And first, we wanted to take a look at how the broader housing market is doing. This slide has a lot of charts on it. It's a bit busy, but it still has some interesting observations. You can see from the chart on the top, top left-hand side, that housing inventories are still at historically low levels, while single family housing starts also remain below the national average. However, we have seen some prices in the housing market beginning to stabilize in many markets after showing some decline. If you look at the two charts on the bottom, rental vacancy rates still remain below the historical national average of 7.3% down to 5.8%. So the demand for homes is still there, even while the real estate market, is still absorbing the pain from higher mortgage rates. So with demand still remaining high, home affordability is also a challenge, which is why you're starting to see multifamily housing starts above the national average. Multifamily homes typically tend to be cheaper and can house more people, especially when the land is limited and there's a high density of people. Think of where a lot of corporate centers are or city centers. When the land is limited, there's sort of no place to go from up there. And if we look at the next slide, which shows why housing matters, so housing goes, so goes the economy sometimes. And as the 30-year mortgage rates slowly start to come down from their 52-week highs of around 7.41% to 6.96%, you can see that home sales are slowly starting to rise again as buyers who were sort of pushed out in the market are coming back into the market. And the top left-hand side of the graph, mortgage applications have risen 7 out of 8 weeks in a row, even though home sales are still rising or are starting to begin to rise. You can see how low inventories are still affecting affordability. The bottom right-hand graph shows you the affordability index is dipping below 100, meaning when it dips below 100, that means that families in the US are reaching peak affordability, with the median income starting to have less than enough income to qualify for a mortgage on a median priced home in the US. So from that, it's not too surprising to see the University of Michigan consumer sentiment for buying conditions remaining depressed as younger people continue to feel priced out of the market. And as we look at, how consumers are spending their money, obviously consumers spending on goods and services make up about 68% of GDP. Real consumer spending did increase at a pretty robust rate of 4.3%, but you can see the dramatic decline in savings rates from their pandemic peaks in 2020 when people had stimulus coming in, but nowhere to go and sort of nothing to spend on there. While revolving credit card spending has remained consistently above that 5% level that you can see here. On the right-hand side, that's showing you that spending on services continues to be elevated, hence the stickiness that we're continuing to hear from the Federal Reserve, while spending on goods has essentially flatlined. Everyone has bought in the Peloton that they're going to buy at this point. And this goes back to comments made earlier from Jeff regarding slowing manufacturing in the US.
Thanks, Maddie. I think it would be inappropriate to not spend at least a few minutes on kind of the banking environment. And I think, to try to tie that together with the sentiment concept, right? Like, so if you're worried about your money at your bank, you're probably looking to spread that money out, to other places, not looking to spend the money, right? Although some people would rationalize that the bank was going to lose it, you may as well spend it on your own. But the truth be told is, we saw a little bit of a decline in consumer sentiment related to just worries about the banking business. But if you look at banks in general, right, like it's a much different place than we've been in the past, right? If you go back to the 08, 09 timeline, capital ratios were much lower, right? You can actually see, in the midst of the recession, in 08 in the gray bar, that capital ratios had fallen below 10%. We had Basel II, really require banks to hold much more in capital, much more capital reserve. Obviously got out of other businesses like prop trading or significantly shrink the role. So when we think about the ability for banks to absorb shocks in the economic system, they're much better than they are today. So again, we want to make it very clear, and this is what I kind of harped on in my Legacy of Lehman Insight piece from probably about a month or so ago, that this is not a repeat of the financial crisis. We are seeing some tightening of lending standards, right? Some of that was natural, right? You can see that was beginning to happen, really in 2021, 2022, before the banking crisis. It's accelerated over the course of the last month or so. Whether or not that continues to be the theme or not, we'll see. But why bank lending standards have tightened a bit has a lot to do with existing loans on their books, right? I think banks were of the belief, and a lot of investors as well, that rates were going to go up more slowly. So banks have a fair amount of loans in their portfolio with relatively modest interest rates, knowing that those today might look really unappealing, would make it difficult for them to rationalize doing additional underwriting unless the conditions were really great, right? Especially if we're worried about a recession on the horizon, as the Fed has intimated. So again, just banks are going to be fine. I'm actually pretty constructive on financials, mainly the mega centers. That was actually something I put in the piece again probably about a month or so ago. Whereas the issue seems to be a little more localized to the regionals, and we'll talk a bit more about that later as we spend a moment on commercial real estate. What we want to look at is what's creating some short-term headwinds for banks in general, right? So you can see bank deposits in the last year or two after spiking during the pandemic have materially slowed, and they've slowed for two reasons. One is, again, people have been spending the money, but people have also become much more sensitive to, hey, I can get returns elsewhere. I remember this back in 2005 and 6 when the Fed raised rates from 1% to 5.25%. You would have people coming in with checks to put money in money market funds because the rates were much better than the savings account or what they're getting CDs. So that same thing's happening today. Again, you have money market funds paying 4.5% to 5%, whereas the national average on bank savings is still around 0.5%, give or take. So as long as that continues to be the case, that will have some impact on a bank's ability to go ahead and provide loans, right? If they're not adequately reserved, then it limits what their lending profile looks like. One quick thing to speak to with respect to the responses from both the Fed and the Treasury in the midst of the craziness that was those 2 weeks in March. The Fed has really over the last 15 years or so been very much active. And part of the reason why their independence is so critical, and I won't get into the political argument here, is that they have the ability to take extraordinary measures. We did this back in the financial crisis, kind of with the institution of quantitative easing. We did this back in the pandemic, where the Fed was no longer simply the lender of last resort, but also the buyer of last resort, as they talked about buying, credit, right? So buying bonds, both from issuers or investment grade, as well as even some high yield bonds. And then most recently, their ability to create a window where banks can post collateral, right, independent of their mark-to-market value. So let's say you have a treasury security or an agency bond you bought a couple of years ago, you paid par for it, it's now 90 cents on the dollar. You can pledge that as collateral at par, even though if you were to sell it to somebody else, you'd sell it for a 10% discount. So you saw a significant amount of lending or borrowing take place on the part of banks. Part of that was just precautionary. And then there are some banks idiosyncratically that we're seeing some asset flows, right? I think First Republic or Western Alliance too, in particular, that have very concentrated, consumers or clients, specifically the high net worth or, venture capital, so on and so forth. So again, this has shown signs of significantly waning or the tapping into these lines have been reduced, but again, something worth paying attention to.
And if we look at, start with everyone's favorite topic on inflation, this chart shows the change in prices between 1973, which was actually the start of a 10-year inflation cycle that accumulated with Volcker's raising short-term interest rates to over 20% in 1982, and then ending in the start of this year with recessions indicated by those light gray bars that are running through the middle of the chart there. Headline CPI, including food and energy, is in blue, while the core CPI, excluding food and energy, is in that dark gray line, with the average of 4% being the dotted line going through the middle of the chart there. Headline CPI is coming down slightly from 6.3% to 6% in February of 2023. Obviously, this is down, a little over 3 percentage points from its trailing 12-month high of 9% back in June of last year. So hopefully this is likely to provide, a lot of welcomed relief to US consumers who have been bearing the brunt of these higher prices. And if we look at the inflation heat map, this is something, that we had showed last time, but we think it's important to continue to look at. This is showing you exactly where inflation is hitting our pockets the hardest. While it's mostly in core services, the redder the inflation map, the worse it is. The greener the inflation map, the better inflation is coming down. So the redder is where it's stickiest. And you can see that most things have come down considerably from the peak of last summer, especially when it comes to gas and electricity, while core goods, even used cars have come down as well. And then if we look at that from a global perspective here, inflation still remains high given the pressure from the war in Ukraine. Obviously, you can see that Russia, last time we showed this graph, was at 12%. Now it's at 11%. So it's starting to come down, but still higher than in the US. We've seen some moderate improvements to global supply chains and obviously stabilization in energy prices. European Union avoided their energy crisis, which stabilized prices over there as well. Faster economic growth in China could lead to higher inflationary pressures, but may also help combat supply chain shortages as well. So that's sort of to be determined here.
Yeah, let me grab the opportunity to spend some time on labor, right? So we talked about housing, right? Most valuable asset for most Americans. But I think clearly the biggest driver of your sentiment has a lot to do with your employment situation, right? So you can see we're at a 3.6% unemployment rate, so that's a positive. If you look back the long run, the unemployment rate going back 50 years, it's kind of surprising when we looked at this chart, it was as high as 6.2%, right? Again, in more recent years, we've thought about full employment around that 4.5% time, 4.5% level, excuse me. And then what we're seeing in terms of the environment today is relatively high level of employment, so called tight labor markets. The JOLTS report, which we'll actually spend a minute on in a moment, still shows a lot of job openings. But what's the critical piece in all this stuff is really what's going on with wages, right? And really whether or not wages are likely to translate to a wage price spiral. So if you go back to the 1970s, you can see the blue line hovered over the gray line for a number of years. In fact, it got to the point where the gray line had to really jump up to go ahead and see that big decline in the blue line, right? So the idea there is, and this is somewhat in line with what the Fed is talking about when they address the notion of looking for some slackening in labor markets. Like they want a kind of a very neat and tidy 1% increase in unemployment. Again, it's never been something where you've been able to go ahead and just land on that type of increase. Normally, if it goes down, if unemployment goes up by 1%, it goes up going up by 2 or 3%, right? But I'm still somewhat skeptical that wage inflation has become a real problem, right? You could actually make the case that what's happened with wages over the last 2 or 3 years has been a net positive. Obviously, for companies that are particularly labor intensive, it hurts margins. But if you look at the kind of long run story, the different rungs of the socioeconomic strata are impacted more by inflation. So I think that the lower rung of socioeconomic strata generally do look at inflation as a regressive tax, right? But if we're seeing again higher wages there, coupled with the idea that wages tend to be stickier, assuming that inflation does continue to moderate, or in fact we see some disinflation or deflation, that could really be a net positive. So that's something we're watching closely. But by and large, a tight labor markets, I would argue, is still a positive thing. But again, worth monitoring, especially over the course of the next few months, as we get into a period of time when lending standards and some other factors could impact companies' ability to maintain their headcount. Yeah, this gets back to the confidence factor that you see, with labor, right? Again, U.S. unemployment rate has fallen to these low levels. But you're also seeing the same thing in Japan. You're seeing the same things in China, and obviously in the eurozone. So directionally, that's a good thing. Although again, I always scratch my head to see that Europeans have an unemployment rate that's nearly 7.5%. But despite the fact that the unemployment rate has plumbed these real low levels, we actually haven't seen a commensurate rise in confidence that you normally see as labor markets are healthier, right? So we actually saw much healthier confidence levels with respect to the employment outlook, even 1 or 2 years ago, right? Some of that's just simply people reading the headlines and hearing from central bankers all around the world that we have to get inflation under control. But I'll tie this all together in a moment. But again, some of the data on both housing and labor are clearly creating some noise for the consumer when it comes to their confidence levels. Here's the piece that I would say is more important that most people don't pay a lot of attention to. Every Thursday morning, 8:30, you get weekly unemployment filings. Initial claims have ticked up a little bit over the course of the last few weeks, even though the last month and a half or so. So we're running around to 230, 240, 230, 240,000. These are new filings, right? Those numbers are historically quite low, especially given the level of unemployment we have today. Where we would start to get a little bit more worried and thinking about labor as a leading indicator is if we saw unemployment filings start to jump up around that 300,000 level. So if you wanted to be focusing on a data point that you get with pretty much high frequency, Thursday morning, 8:30 will start to be a place to focus if you're so inclined. But again, right now it's a positive. Businesses continue to be comfortable with their headcount, or maybe are still hoarding people, reluctant that if they let them go, that'd be hard to get them back.
And everyone wants to know what the Federal Reserve is going to be doing in the future. Right now is for May, it's really a coin toss. If we had to guess if they're going to raise rates again, but they expect the year to end at 5.1%, which implies one more rate hike, but perhaps more importantly, no rate cuts. So the market thinks that they'll be cutting rates by the fall, but the Federal Reserve's projection for inflation back in the threes by the year end, while unemployment jumps up by 1%. So to be determined if that actually happens, but trend growth in real terms is set to be around 2% for inflation. And if we look at how that affects currency and commodities here, this is something that Jeff had commented back on a piece in the fall. So the dollar's reversal, from its peak in October has definitely been a good thing for asset prices. And we're seeing some strength happen in the euro, the yen, and the British pound. Commodities continue to be volatile. Metals have performed well for cars and batteries and things like that. But food and energy prices have begun to soften as well.
So that's a good recap of the kind of macro picture. I know there's other areas of focus, but in the effort of not keeping you guys with us for 3 hours, although I'm happy to have those conversations, we'll dive into the market. The first slide's a bit of an eye chart, so we'll stop for a moment so you can take a look at it. But I want to highlight a few things in here. So the top basically addresses kind of market or index levels. The thing that you probably are looking at specific to the quarter is the column that's second from the right. Right, first quarter 2023 sorted. Nasdaq up 17%, S&P up 7.5%, small cap stocks up 2.5%. Right, so quite a disparity from the mega caps, specifically the tech side, to the smaller names. At the sector level, tech, communication services, which is where you'll find Google, Meta Platforms, formerly Facebook, as well as Netflix, were also up 20+%, right? So pretty impressive showing. Consumer discretionary, which is where you find Amazon, up 16%. So very interesting story, right? Like the market having a decent quarter by anyone's standard, 7.5%, was really just, again, propelled by the power of a few names, right? Meta Platforms, again, former Facebook parent, is up 70% on the year, right? So we had a similar scenario in 2020, right? Where the S&P ended the year about 18% positive. But if you didn't own the big cap tech names, you probably had a flattish to even down year, right? If you go below the 7.5% return in the S&P, you can see the tough spots for the quarter: healthcare, energy, and financials. Energy, again, makes sense as oil prices have declined. Financials really that came on the back of what happened in the last month of the quarter. But some of the other areas, specifically healthcare, utilities, and consumer staples, which were kind of middle of the pack or lower, were really because they did well last year. They held up, and so it was a kind of a reversal of risk appetite on, and so some of the more defensive names didn't perform nearly as well. Jumping to fixed income for a second, and we're going to spend more time on this a little later on, but you look at where rates are today, from where they were a year ago. I mean, the Fed funds is up 450 basis points, right? I mean, that's a massive amount of move in that time frame. The 10 years up 118 basis points, and the 30 years up 125. So rates across the curve are up, but when the shorter end is up higher than the longer end, you have this conversation about inversion. We'll again spend some time there. And then internationally, right? Again, everyone's favorite topic, as we've joked about in the past, and Maddie will spend time with us on the international side. Pretty good story abroad, right? Specifically in places like Paris, or France, where they're riding the streets because they're increasing the retirement age to 64. So again, from my perspective, interesting to see what's happening abroad. So we'll dive in a little bit more closely on the domestic side here. And again, the slide something you guys can pour over when we get this deck out to you. So on the 1 year basis, second column, first column is a quarter basis, pretty much across the board positive in the quarter. Where commodities were the only place in the red. 1 year still negative returns, right? We're still very much dealing with the sell-off that started in January of 2022. But if you look out 3 years, other than fixed income and then both U.S. and abroad, you had positive returns. 5 year, pretty much a similar story. Emerging market stocks were flat, and over a 10 year, again, the exception of fixed income and commodities, returns have been pretty good. We just emphasize the importance of kind of thinking long term. To getting back to the next piece on sectors, right? It's important to understand, both what's driving returns, but also where valuations are, right? I'm a huge believer of, what you're paying today is going to have a huge influence on what your returns are in the future, and that should be a very common sense statement. But unfortunately, investors don't seem to follow those tenets, right? So if you look at the forward PE column, which is the fourth from the right, you see the S&P trades at 18 times. That's right in line with the 20-year average, but it's historically expensive, right? Since 1990, right? So let's call it the 30-year average, about 17 times. Tech today at 25 times is expensive, right? By any standard, it's hard for you to make a case that tech is cheap. Where you do see some sectors or industries pretty close to the long run average, right? Technology, healthcare and financials pretty close to their long run average, considerably less than the market is today. And then you see other areas which are reasonably priced, right? Like, I think by anyone's standards, materials, industrials look reasonable, and then energy is still really, really cheap, right? So again, as a value kind of tilted shop, we do pay attention to this. It does have some bearing on where we might bias or tilt within client portfolios. Again, I think over the course of the next 2-3 years, value is likely to outperform, as has been the case for the last 18 months, with the exception of the last quarter, where growth seemed to outshine, especially in the month of March. This is kind of an interesting piece. Again, it's on the left-hand side, when you have an environment where value stocks are considerably cheaper than growth stocks. And so what you do is you take the multiple of the value cohort, right? Kind of 50% of the market, and you divide that by the multiple of the growth cohort. And the longer run average, again, going back here for the last 20 years or so, 25, is about 0.71, right? So when value stocks trade at a discount of 0.71 or lower, right, that's usually a good time to own value. And when that discount is higher than that, right? So when growth stocks represent a better quote unquote value, even though they're growth stocks, you're better off owning growth, right? So you can see above the perforated line, back after the GFC, growth was much more attractive on a valuation basis. Whereas, the kind of shoulders of the head and shoulders chart suggest value is likely to or poised to do well over the course of the coming years. Again, from the standpoint of valuation, you can make the case that specifically energy and to a lesser extent materials are compelling. I'll just leave real estate aside for now, having a lot to do with some questions about the commercial real estate market. And the last thing I'll say on the domestic front is all about earnings, right? Like, so, we hear the word recession a lot. Recessions from the standpoint of economy, and if you go back to a few slides ago, we've had 6 recessions since 1973. You can look here, the green bar represent recessions, which is a 1-year decline in earnings from the prior year. We've seen plenty of earnings recessions. We had one in 2022 where earnings basically declined year on year. We expect earnings to grow this year. Again, most of that's likely to come in the very back half of the year. But again, I'm still of the school of thought that earnings are likely to beat to the upside by way of the fact that demand is still there and companies are extremely efficient, right? You can look on the right-hand side of this page and you can see, how important margins are relative to earnings. And while margins peaked around 13% back in 2021 and have come back down to 11%, there's a pretty good chance that they could actually tick back up again, which would just justify or rationalize a slightly higher multiple. I'm not making a case for big multiple expansion at this point, but if again margins can hold up or actually go up a little bit, you can make the case that stocks can trade at 18, 19 times, especially if rates come down.
And if now we're going to move on to international and emerging markets here. So if we look at the global equity market summary, international and emerging stocks performed well last quarter, continuing the case for maintaining, a well-diversified portfolio, especially based on valuations being cheap and sentiment being poor or low. Europe outperformed the US, which with much of those gains beginning last fall. More commodity exposure boost returns somewhat. Valuations were cheaper. A weaker dollar also boosted returns, and we'll hit on that in a few slides here. And then Europe averted that energy disaster or energy shortage disaster, not coming to fruition as well, boosted returns. China's economic reopening may increase emerging market valuations in future quarters. Again, that's to be determined here. And if we look at how valuations have affected returns, you can see that international and emerging markets are trading right around their 15-year average, roughly 70 cents on the dollar versus the US, continuing the case for having or keeping international exposure. And if we look at that again in a different way, this is comparing valuations around the globe. You can see that the US in red there is still trading above its long-term average, while many countries are trading at a discount, including, you can see China here, Japan is trading at a discount, Chile, Turkey, well, only a few countries are still trading above their valuations, including Portugal, Ireland, obviously the US, Saudi Arabia, and so on and so forth. And if we move on to the impact of international and emerging markets growth on why valuations matter, you can see on the left here that GDP in 2008 with advanced economies in the US made up 69% of global GDP, versus on the left, fast forward to 2022, the US and advanced economies make up only 57% of global GDP. So the US has increased slightly while advanced economies have decreased by 14%. Emerging markets now make up 12% more than what they did in 2008 and also have the world's largest population. So, 75% of GDP is outside of the US and we're only 5% of the world's population. So again, just making that case for keeping and maintaining international and emerging markets in your portfolio. And if we come back to how the dollar strength has accumulated to larger returns in both of those markets. So when the dollar is weakening, it tends to be good for overseas stock returns. And this is in addition to cheaper valuations. So you can see why emerging markets and international stocks have performed so well. So the US dollar is starting to depreciate. And this shows you on average how international and emerging markets have performed when the dollar does weaken. So you can see here, 9.9%. If it depreciates 10 to 5%, they have even better returns there.
Fixed income, right? Everyone's excited about fixed income after a lousy year last year, right? 13% decline, worst year on record for the aggregate bond index. There's a lot of talk about being excited about bonds. I know for a lot of people that's really hard, the idea of being excited about bonds, but it was a good quarter, right? Like just to not be as much of a wise guy, right? You see the ag was up 3% for the quarter, right? Annualized out to a 12% return. I think we'd all sign up for that. We expect that to moderate a bit. I mean, some of that was just really a byproduct of a pretty significant rally in flight to safety or risk-free assets that took place in the middle of March. 10-year was back around 4 and then dropped all the way down to about 330. We're back around 350, give or take. But again, if you're going to go ahead and look at the first quarter, you'd have to say across the board is a pretty good time to invest in fixed income. Investment grade, kind of call it 3%, non-investment grade a little bit north of that, and then investing abroad, specifically in emerging market local debt, where again that dollar dynamic has helped source the return, add the return, has been a pretty decent story, right? And then if you look at dividend stocks, which again we'll tie this all together in a minute, they had a rough quarter, right? Like so again, if you're betting on utilities, consumer staples, financials, kind of the yield hogs, you probably didn't have a great quarter, especially with the fixed income. To be clear, we like fixed income as a source of ballast, right? I wouldn't look at returns and fixed income to be enough to get the job done, right? They should hopefully over the next few years keep pace with inflation versus the last couple of years prior, they were likely to lag inflation. But again, hard to not look at this chart and feel a little bit better about what the bottom line was for the quarter. When we look at the question about the bond marketplace and whether or not the bond market's smarter of the two markets when compared to the equity markets, usually we'll see that the bond market tends to be sending signals before the U.S. market does. Actually, the equity market does. So what's pretty interesting to us today is you can see that while there's been talk about recessions, there's been talk about distress, spreads remain relatively benign, right? You go back to the financial crisis, and you see on the left-hand side, spreads on high yield were 18%, right? So if you get a treasury bond paying 3%, you're getting high yield paying at 21%. Today, treasury's at 3.5 and high yield at 8 means, yeah, you're getting more, but I wouldn't describe that as a particularly attractive risk return profile, right? And again, spreads outside of the U.S., right, are also still showing signs that things are pretty healthy out there, or the likelihood of material credit deterioration doesn't seem there, right? So again, something we'll watch closely. Like again, if I saw spreads widen out significantly, we could make a case to increase our exposure to high yield, where we're significantly underweight at present. We'll take our risk with equities before we don't fix high yield fixed income today, just given the risk return profile. And then I just want to spend a minute with you on this, because this is a question people ask a lot about, what happens if interest rates go up or down from here, right? And so what we're looking at mainly on the right-hand side is a decrease of 1% on rates. Like what would that translate to in returns for U.S. Treasuries, TIPS, investment grade corporates, convertibles, so on and so forth. So again, across the board, you'll see pretty much anything in the fixed income space would benefit from a declining rate environment by and large. I think that your risk is more likely over the course of the next 6-12 months that rates will actually increase, not so much the Fed, we'll talk about that in a moment, but more along the lines of market rates, right? So the 10-year, getting back from here to 350 to 4 is more likely to me than from 350 to 3. But again, across the board, you look on the left-hand side, yields are pretty attractive, right? So in a world where it was not that long ago, you got 1% for fixed income, you're now getting 4 over a 10-year span of time. It's a big difference in cumulative return of 40% versus 10. Last thing I'll say on the fixed income side is there's a view that rising interest rates is bad for fixed income. It's not. It's just not good for fixed income, right? So when you see interest rates go up, assuming they go up in a measured way, it has a positive effect on your portfolio in the sense that as you get interest payments, those can be reinvested at higher rates. As bonds mature, they can be rolled over at higher rates. So again, we're not necessarily panicked by the notion of higher interest rates. Again, largely speaking, most of the rate hikes that we saw in 2022 represent kind of the aggressive part of the tightening. But again, all things being equal, higher interest rates for long-term investors are a net positive. And again, we'd like to see some additional incremental yield on high yield, to justify more exposure there. But investment grade credit, at 5% plus looks pretty compelling today. Maddie, I think it's on mute, unfortunately.
Sorry, I think I would have learned that lesson by now. But if we look at how this affects overall asset class returns and speaks to your asset allocation, one of the most important things when looking at your overall return, the first thing that we wanted to start with is this Callan chart format. We've all seen this before. This shows the different asset classes and returns compared over a number of years. This chart in particular is looking from 2008 to year to date, or 2022. And the main takeaway here is always that the return pattern is random. There's been a ton of discussion and articles written on if the 60-40 portfolio is dead. And you can see here the 60-40 portfolio are these boxes here in white, that it is in fact not dead. And we look at that from a risk and return perspective. So, we look at a diversified portfolio capturing most of the upside without taking on as much risk as the overall market. So if we look at this from 2008 to 2022, the 60-40 diversified portfolio, which is that box in white here, is the fourth best performer on the overall asset class chart. And from a volatility or from a risk perspective, it was 8 out of 10 on that scale. And so if we look at that from a time perspective on how a blended portfolio, so now we're taking less risk, we're bringing the blended portfolio down to 50% stocks, 50% bonds, and how they performed over a longer period of time from 1950 to 2022. You can see that stocks had an average annualized return of 11.1%, bonds being at 5.5%, and the diversified 50-50 portfolio at 8.7%. And you can see that the 50-50 portfolio captured 78% of the upside of the market while only taking 50% of the risk. So essentially, that's always what we want to do, capture as much of the upside as possible while not being, taking on the risk of the downside as well. And what I think is really interesting here is that, if you look at a 20-year rolling period, which is that right-hand side of the chart there's no negative return in any of those three asset classes. So the worst performer was at bonds, being at 1%. So we always want to make sure we have a diversified portfolio and the right asset allocation mix between stocks, bonds, and cash. And not taking any unnecessary risk is the key point here. So markets do well, and investors generally lag the market based on poor timing decisions, often influenced by their emotions. The Del bar, which is obviously not pictured here, generally indicates many investors leave as much as 50% of their return on the table. So this is a number, that we want to get right and that you feel comfortable and confident with. And as always, we've shown this slide before. I'm sure many of you have seen it, but we want to show why it's important to stay the course. And again, feeling comfortable and confident in your investment strategy once we've sort of backed into the numbers with you on how much risk and reward you need. So we talk about that often, but these are the numbers behind why it's so important. So with the average return of the S&P 500 being at 9.8, almost 10% between 2003 and 2022, if you miss the 10 best days in the market, you almost cut your return in half to 5.6%, while excluding the top 20 days is obviously even worse. You have control over how much risk you're taking, but it's important to stick to your strategy once it's in place. And if we look at this, being realistic matters, especially in this environment and having such a run up in the market from the past 10 years. This is showing you expected asset class returns. Asset class returns are likely to, as you can see here, be lower than average, but still positive. So the average returns are likely or are higher because of the past 10 years being really good in the run up in the market. What's particularly interesting with this chart, but obviously not surprising, as we talked about international and emerging markets doing so well, is they're closest to their average with a forecast of 7.6%. And if you need to capture, a certain return hurdle to cover your expenses, we always can back into these asset classes and make sure you have the most appropriate mix for your situation.
Let me come back to confidence, right? So we talked a lot about the housing, we talked a lot about that with jobs and whatnot. It's interesting, right? So confidence is the name of the game, right? When you have a crisis in confidence, everything else goes out the window. And so to some extent, that was kind of what was the doom of Silicon Valley Bank, or Silvergate, or Signature Bank for that matter. But looking at it from a big picture perspective, it's really important to understand how confidence impacts the market, right? Like, it's not uncommon lately to hear from the quote unquote experts that, like, the market's too expensive today, it's frothy, it's overbought, blah blah blah. But what's very interesting is when sentiment ultimately is closer to its bottom, that tends to portend pretty good returns in the future. And the other end of the spectrum is confidence tends to be elevated, usually means expectations or future returns are too high, right? So we can see where we were back in March, and that really has moved up a little bit. There's still a fairly negative sentiment out there, and it's that age-old adage, right? The markets climb walls of worry. So I would say the individual consumer, feels a little bit down in the dumps. Again, that's generally not a bad time to own stocks. And then the next slide is one I find even more amusing, which is the smart money, right, shares the exact same sentiment. So this is a survey done by Bank of America that looks at, like, fund managers and to gauge their sentiment on the future returns in the markets. And it's very interesting, like, their net overweight to equities at the lowest levels they've been since not the pandemic. This is actually exceeds the pandemic, but really back all the way to the GFC. And so if you look at the returns after that time frame, they tend to be pretty positive for equity. So again, even the quote unquote experts are a little bit too pessimistic, at least as I think about the next 5, 10, 15 years. Spending a couple more minutes on portfolio construction, because these are questions that come up a lot, and what we're doing and how we're doing it. So if you're in the camp that inflation is going to remain above 4% for the foreseeable future, you clearly want to have more exposure to commodities and gold. Whether or not the commodity super cycle, another one, is underway is a question. The rise of nationalism, deglobalization, onshoring, whatever you want to describe it as, could translate to higher commodity prices. We've also seen cost rationalization being a source of minimizing production, specifically in the oil and gas space, but even to some extent in metals and mining. So again, if inflation you do believe is stickier, right, we would look to add exposure to those areas. I'm still in the camp of long-term transitory, right? You probably got that from one of my other missives. But if that's the case and inflation does in fact continue to moderate, you'll be rewarded handsomely enough when owning owning U.S. equities and overseas equities. But again, now based on the level of where we're at with fixed income, capturing a return that's likely in line with, if not a little bit ahead of inflation's a possibility. So again, for those investors who are really nervous on inflation, we can have a conversation on that. But again, I think that's likely to be a story that will continue to improve over the coming months. Where you do want to be today is probably in quality, though, right? Like, and it seems like fairly logical statement itself, but quality is a factor, right? It goes back to the University of Chicago days, and slicing companies down based on different factors, whether it's size or it's momentum or value. Quality just speaks to the fact that businesses are less levered, tend to have more disciplined management, a thoughtful approach around capital return, whether it's dividends or buybacks. So when you look at quality stocks, when the Fed is wrapping up, these are the companies that tend to do quite well. I know there's a thought out there that you want to catch the garbage stocks at the bottom of the economic cycle and have them run up. And look, if you can time that, super. I wish you the best of luck. It's very difficult to do that. We can always go back and circle the chart after it's happened. But quality is a good place to be, where you can see over the 1, 2, and 3 years that quality or solid companies, which again tend to be found more in the value space, oftentimes outperform as we wrap up, tightening cycles. And you can see there's a number of tightening periods that were measured here. The last thing I'll say on the notion of portfolio construction and how you can play a little defense while still being offense is a lot about dividends. And while the yield in the S&P today is paltry at 1.6, 1.7%, you're seeing companies with a greater willingness to raise a dividend or increase a dividend. I still think there's a handful of big technology companies, whether it's Facebook or Meta, or Alphabet or Amazon, start instituting a dividend in the not too distant future. But just companies that have just consistently been able to dedicate their focus to having a consistent cash flow to reward shareholders. And you can see reinvesting dividends will significantly impact the compounding effect in your returns, right? Like, if the markets have returned 10%, but you're reinvesting your 2 or 3% dividend every year, you can appreciate how that impact on your portfolio value is pretty stark. And again, it's almost a threefold increase. And you look at the power of reinvesting of dividends. So I want to spend a minute on what keeps us up at night too, right? Because there's not uncommon for someone to leave a meeting with me or my quarterly market review calls, whether my prior life at Fidelity or today, where I sound optimistic. And in the long run, I am optimistic, right? It's, I look at my own personal circumstances and wake up every morning pitching myself as how fortunate I am to be in the position that I'm in. And I think we definitely want that to be something we all appreciate as we invest. But, the government is on a unsustainable track. If you look on the left-hand side, right, spending is about 6.2 trillion, right? That's the budget. And you can see that we bring in from various revenue streams, right? Income tax, corporate, the personal income tax, corporate income tax, social insurance, which is Medicare and Social Security, but about roughly speaking, 4.7 billion. So we need to actually borrow $1.4 billion to finance our spending, our budget deficit. And running twin deficits, trade and budget deficits, in the long run can be a bit of a problem, right? So what's important is at some point in the not too distant future, we do acknowledge the fact we need to do two things. One is cut spending, but also raise revenue in the form of higher taxes, right? I'm optimistic that we don't get to a point where we have a real debt ceiling showdown. I know McCarthy had talked about extending the debt ceiling for a year. I think that's an interesting idea. It does mean it becomes a political hot potato as we get into election year next year. But the idea of having these things every 12 months is nauseating, right? But again, just to be clear, deficit spending will work, generally speaking, in short windows of time, generally around recessions. It shouldn't be something we're doing while the economy is expanding, and we've been doing that really for the better part of the last 10 years. So again, we'll continue to monitor this, and again, this is important as it relates to long-term value of the dollar as a reserve currency, but also interest rates. And if investors lose faith in the U.S.'s ability to maintain a fiscally disciplined process, interest rates by and large will go up, which will mean a significant portion of our budget spending, which you can see the net interest is $640 billion will rise, which means money is going to come out of social services, education, defense. The other worry, if I want to go ahead and look at it, is commercial real estate, right? Like, so if you're paying attention today, we're seeing more and more about commercial real estate, and is it the next canary in the coal mine? It's, to be clear, it's not a 2005-6 story with residential housing, where back then you could basically borrow the entirety of the value of the house, if not actually borrow 120% of the value of the house, right? Like, there were times when people were buying properties with ninja loans, no income, no job, applications with nothing down. By most commercial real estate does have a loan to value at or origination somewhere around 70%, some even more so, 50%. So again, there's a pretty big cushion on the side of the lender. But as things were acquired back in 2021 when interest rates were low and prices were high, some of that paper has to roll over the course of the next couple of years. And so it's going to be interesting to see what the economics look like, right? We've seen Brookfield, the big asset manager in Canada, walk away from a couple of deals called the strategic default, which essentially means that they're trying to negotiate with their lenders for better terms. Again, I think it's worth monitoring specifically around two areas, right? One is office space, which everyone knows about, especially with hybrid work, but the other one is senior living facilities. Again, a lot of the work that was done 10, 15 years ago was extrapolating out in the population, this aging baby boomer cohort. But as the pandemic showed, it was pretty clear a lot of people want to age in place, right? So there's excess capacity there, and the labor costs at these nursing facilities are extremely high, right? You need nurses, you need labor who's capable of doing what might be described as jobs that are well, critically important, not as that desirable, right? So again, it's those are two areas of particular concern. Multifamily housing is probably going to be fine. And a medical logistics infrastructure, called warehousing, and even retail is probably better positioned today because we've been talking about the death of Amazon for the better part of a decade. So if you look on the heat map again over here, you can see really mall and office property, or where there's a bigger challenge, right? Look at the bottom here, effective LTVs are in the 60+% territory. Again, retail or mall properties, that's a known issue. Whereas office, that's really kind of snowballed here over the last few years. So again, we'll watch that closely. That's the somewhat bear case for owning regional banks. And one of the things that was unique to Signature Bank, the New York bank that was wound down by the FDIC, was that they had a significant commercial loan book. So again, we'll see what happens over the course of the next 2-3 years there, but something worth monitoring. So in summary, look, I would say we'll put a bow on a good quarter, right? Positive returns for both stocks and bonds, domestic and foreign, value and growth more than value, but again, across the board in the black. Again, that was actually the theme in the fourth quarter last year. So we put together 2 solid quarters, but tighter monetary policy is having its effect, right? We're seeing inflation abate, but the economy has shown some signs of slowing down. I mean, the Fed has, actually intimated in their Fed minutes from March that they saw a recession later this year, which is interesting because they're still talking about the idea of raising rates next 2 weeks out, which again I find to be somewhat confusing, if not laughable. The things that keep us with an optimistic tone, again, labor and housing, suggests that the consumer will have the capacity to, keep the economy propped up, even if their sentiment levels aren't great. Let's pay attention to the evaluations today, right? We're not at a point where you can just shoot fish in a barrel where stocks are just so cheap, or bonds are so cheap you're going to make money. We do think that the dynamic today is such that you'll be rewarded, especially if you've got an intermediate to longer time frame with a value tilt. And then again, overseas is clearly a place for us to go ahead and increase our weightings. We're still very much a domestic tilted shop, but again, having a little more overseas exposure makes sense. So, and again, knowing the population that's attending the call, I thought that Jim Morrison's, the Doors, "This is the end" would be an interesting way to kind of segue our part of the conversation. So we'll open up to Q&A. Maddie, I know you have the queue there. See if there's any questions that have come in, and we're happy to address any questions that we have these next few minutes.
Sure, we do have one question here, and feel free to put any of your questions in the chat there, which is, how do you create a sort of quote unquote safety net within the portfolio while the portfolio is still, not back where it was at the end of 2020, beginning of 2021?
You want to take that one, or you want me to take that one?
You can take it.
Yeah. So I mean, it's interesting. Like, this is kind of the revisionist history. So the markets, basically from 2022 are down. But if you look back a year, it's been more than a year, 2 years, 3 years back, most investors are kind of right around those same levels. So to be defensive, but at the same time still participate if the market goes up, I think it's a combination of a couple things, right? So it is, again, being in a position where, yes, you might have a little bit greater indexing to equities, right? So the joke for the investment community is the 70-30 is the new 60-40, right? So being a little bit overweight in equities can make sense, but being overweight in equities, which have a margin for safety, right? Stuff that frankly isn't priced for perfection or doesn't need 3 or 4 things to break right, but if 1 or 2 things break right, is okay. In fixed income, again, if you tilt the duration profile of your portfolio a bit, right, intermediate to shorter will actually provide you, a bit more compensation than being out intermediate to longer today. And I do think that, at the margins, if you pulled in some riskier assets, specifically emerging market equity, you actually can reduce the overall risk profile of the portfolio, but still possibly capture some positive returns if, in fact, inflation needs to moderate. The dollar weakens, which is something that's a really good thing for emerging markets. So, hopefully that's a good answer. And again, for the specific, audience, right, or the audience specifically, if you have questions of how we might tweak or adjust something for the portfolio, we're happy to do that.
And we have another question that just came in as well. So recent chatter about US dollar not being the reserve currency, timing and result if that is the case.
Yeah, it's a good question, right? So, there's a lot of talk lately, again, especially the dollar on this slide since October about, is the U.S. role as the reserve currency dead? I think some of this is a worthwhile question to understand kind of geopolitics, right? The dollar did something, or excuse me, the U.S. did something, somewhat aggressive last year, specifically around freezing out Russia's supply of dollars, right? Kind of like basically locked their currency. And so, a little bit of it is about control, right? You don't want to have, U.S., geopolitical policy impact your access to your reserves. But I think it's tricky today to say that the dollar would lose its hegemon status because you really have to replace it with something else. And so China, which is a growing economy but has its big problems, especially look at the future, doesn't acknowledge the rule of law, isn't all that interested in a free float of the currency. So, the other currencies that could potentially play a bigger role as reserve currencies are, the dollar, excuse me, the euro and the yen. And again, we know they have problems in both those areas, mainly on demographics, but some other factors about it just kind of interest rate policy, especially over the course of the last handful of years. So I would say I'm not ready to write the dollar's obituary quite yet as a reserve currency. It might end up being such that the dollar has a weakening run for the next handful of years, especially because others have to catch up to us on rate policy, but also, but the notion of the dollar no longer being the reserve currency seems unlikely. It's definitely the preferred method of trade out there. So we should have at least another 10 years or so of dollar dominance in the reserve currency space.
And that wraps up our questions for today. We want to be cognizant of the time that we've spent. So we appreciate, the hour and 6 minutes that everyone has spent with us. We'll be sending this out here to all of our clients, but, specifically to those who attended today. And please, as always, feel free to schedule an appointment with us if you want to know how this relates to your situation more specifically.
Thanks so much for the time. We appreciate it. One last thing we'll say is we will have an event for the month of May focusing on behavioral finance, right? Maybe something that's appealing to a younger audience where financial literacy is an important focus for us. But again, some really interesting stuff on how you wire your brain and the way to make yourself a better investor. So we look to see you in May. And again, have a great rest of your tax day. Take care. Bye, everybody.
Thank you.